CORESTATE is a Swiss-based investment manager with activity in Germany, Switzerland, and Austria. It's the main activity in the last 10 years. Sectors covering is mainly retail, accommodation, mainly student housing and service apartments and everything related with accommodation. And we started activity in Spain 2 years ago. We have a possibility to have a joint venture with a local partner, and finally we continue alone. But the economy in Spain is very attractive for this activity because the consumer is growing again. But CORESTATE has around 20 billion under management, and the idea is obviously growing in different sectors and different countries. And we think that is the right time to invest in Southern Europe.
Great, Alejandro.
Hi, I work in Savills in Spain. I've been in the capital markets team for 11 years now. Everybody obviously knows Savills around here, but in Spain we're a particular office, so it's only 70 of us, so it's rather small, and we do commercial real estate for the most part. We specialize in retail and offices, and we also do some hotel and residential, but only from an investment point of view. We've been doing a lot of advisory during the worst times of the market in Spain, so that's provided us good insight of the bad side of the market. And now, fortunately, we're living a great time in our investment market, so really bullish about that.
Great, Bill.
Hi, I'm Bill Hancock. I'm the managing partner of Resolute Asset Management. Resolute is a specialist servicer and asset manager of real estate NPLs and distressed real estate. We're very active in southern, southeastern Europe, where we're involved in servicing activities in Italy, Greece, and Cyprus, as well as broader real estate asset management throughout the region, so often to Romania, Bulgaria, etc. We are one of the, I think it's 3 as at today, independent loan services licensed in Greece. We're the only independent loan servicer active in Cyprus at the moment. We're one of many active in Italy, but we're an active participant across those markets.
Great, David.
David Ryland, partner at Hastings, responsible for corporate real estate in Europe. And we work throughout Europe, but we've been doing a lot of deals recently in Spain with some private equity funds in terms of acquisitions, disposals, joint ventures with local operating partners. Again in Italy on the loan side and hospitality, and also involved at the moment in deals in Croatia and Greece, which again are hospitality related.
Maybe just starting with you, Bill. Just in terms of the sort of macro picture, more capital looking as though it's going to be coming into Europe. Certainly a tendency we heard in our capital flows one for some of that capital to be not necessarily coming into the UK, and maybe can't find a position in Germany, so it's beginning to look east. Do you think that's also going to benefit SEE markets a little bit, and Southern European markets? What's your sense of that?
I think definitely. I mean, we see very considerable capital pressure across the markets I mentioned. So, Italy, we see it. Perhaps actually that's what it is, but we do see it. But in terms of Greece, Cyprus, and as I say, actually into the broader Balkans markets, we see that capital pressure. I think it's very important to bear in mind when you look at Greece and Cyprus, and as I say, actually the Balkans markets as well, the very small proportion of the overall real estate stock which is institutionally investable. That's why I say the capital pressure is less in Italy, because actually there's a much larger proportion of the real estate stock which is investable. So what we see is investors who are getting squeezed out of other markets. They're hearing about the economy turning in Greece and Cyprus and the opportunities in the sector. They're coming there, they're looking, but actually there's a very finite supply of the real estate they want to own long term, and that is causing considerable capital pressure in those segments. It's causing actually a bifurcation of the market, I would say, between the performance of those institutional quality assets and the entirety of the rest of the market.
Okay, good. And I wanted to pick up a little bit again on this sort of more macro level, maybe with you, Jorge. I mean, Alice mentioned in Spain the referendum. How do you see that in terms of Spain? What are the sort of political? Do you see that? Do you see that the same as Alice was mentioning that her colleagues were saying? How do you see that?
It's a very difficult question because all the day in the newspapers during the last 2 months, I think we saw Catalonia is living or something. I think it's a very difficult situation, mainly because it's a part of the country that creates a lot of activity, and I think it's could be very, very bad solution for the country. Finally, we are waiting the October 1st potential, situation that could be very difficult because the Catalonia government likes to have a votation of this, but the central government is not agree with this, and this is a bad solution finally because the relationship between the politicals are very bad, but on the other hand, the people from Catalonia don't like to be away. This type of situations don't have a good solution, but finally my perception is the independence don't happen because it's not possible to have a very small country isolated from Europe and without any support from the central government. But to be honest, this is a difficult situation. We can see what happened, but my perception is independence doesn't exist, but finally the relationship will be damaged. This is my opinion.
Alejandro, did you want to pick up on that? Or
Yeah, I think
stay neutral.
Yeah, could be a different opinion.
It's very difficult to stay neutral here. Yeah, like Jorge said, it's not even an improbability. It's probably an impossibility that Catalonia will ever be independent. There's no historical legitimacy for it, despite the fact that they want everyone else to believe there is. They constantly compare this to what happened with Scotland. And they're really not comparable, both things. This would be comparable to Manchester wanting to be independent, sadly. So it's never going to happen from a very realistic point of view, but it is politically very annoying, and it does create a lot of tension. And at the end of the day, there is some sort of economic impact. Wouldn't know how to quantify it. It's very difficult to actually say so. But the only thing it's doing is creating a sense of political tension between Madrid and Barcelona without proper real consequences being foreseen in the future. I mean, it's very difficult for this to happen.
But from what you can see, there's no real sense that international investors, foreign capital is looking at that and saying, well, I'm not sure what's going on here. That as far as your sense is that that's not perceived as a big risk?
No, I mean, all our clients from abroad would be more than willing to invest in Barcelona if the opportunity was good enough. I mean, I haven't heard a single one saying this is an issue for us, or domestic investors for that matter, despite a couple of comments that have circled the market, but I think they've been taken out of context.
Okay.
But the main concern is related with planning because and sometimes you have a project and the local authorities are not reacting very quick, or they are put some barriers of the entrance of increasing hotels, for example. It's a very clear position, and this is something that creates some concern on this situation. It's not really a stop, but could be a possibility to reduce the flow of capital. Meantime, we have this uncertainty. This is the point.
And David, obviously you've got, you're looking across Europe as well. You've got a five-star movement in Italy, the banking crisis there. How do you see these kind of risks for Southern Europe in comparison to the rest of Europe? Is it just that with Brexit, with other things, we've all got risks, and these are just ones you take into consideration for those particular markets?
Yeah, I think people have become sort of used to an element of political risk, and in some ways perhaps a more robust view about it than there was, say, a year, 18 months ago. I mean, a lot of the elections have happened in Europe already. The Italian government was changed in December, but has actually resulted in any change in policy. And I think the concerns about the euro breaking up don't seem to be there anymore. There seems to be much more sort of confidence and perceptions of greater growth in Europe. I mean, obviously there's a wider sort of systemic sort of political risks that affect every jurisdiction. But I've even seen like an investment case where some people say, well, in southern Eastern Europe, there's actually less political risk than there are in a number of countries in Western Europe. So it's one of those issues that isn't a problem until it's a problem, and there can be an inflection point where sentiment changes. But at the moment, we don't really see it as a significant driver. Even Greece, where there's sort of currency-related concerns, I think the increasing view seems to be that it's highly unlikely that Greece would ever come out of the euro, because the consequences for the economy and inflation and how they'd manage currency would be just too restrictive for them to take on at this time. On the sort of Italian bad debt side, I mean, obviously the NPLs in Italy are the largest throughout Europe. It's a very significant issue there, and one of the problems has partly been the restrictive insolvency law and enforcement, which they've sought to change by modifying some of the laws in terms of the period pre-insolvency to increase creditor rights and the enforcement process. But that generally only applies to newly originated loans, not old loans. But you know, we are seeing activity there, some of which we've been involved in. I mean, a lot of the NPL sales there, for technical reasons, are structured as securitizations rather than conventional sales, and that's partly because of sort of Italian tax and banking license related issues. But we've seen 2 or 3 securitizations of loan portfolios. KKR have effectively entered into an agreement with UniCredit and Banco San Paolo. PIMCO have done the same thing, where they're almost co-venturing with the bank to put further money in, but the new money that goes in doesn't go on the bank's balance sheet, but structured in a way that the banks can mitigate their loss. And of course, the Italians have also introduced this government guarantee scheme, so-called GACS, where they will guarantee the senior tranche of loan notes. There's been a recent deal there, for example, on the Monte dei Paschi bank. So, you know, there's activity in that market, but it is a deep sort of systemic issue there in terms of size.
Okay, good. Tassos, you want to take that over?
Can I just say how happy I am that Greece is not the prime suspect when it comes to political risk anymore? It's not the culprit for a change. In my personal view, the political risk in Europe is now diminished, and the reasons are 2. One is Trump. I think Europe is now understands that they cannot rely on their US allegiance as strongly as before. And the second is Brexit, which I think has caused the core of Europe to consolidate. And we've seen that through the behavior of Merkel in Germany and Macron, who was in Athens only a few days ago. We see some more understanding and bigger willingness to accommodate Southern European concerns. So I think, if anything, political risk in Southern Europe is now less than it was 2 or 3 years ago.
Okay, good. I wanted to just pick up some of the sort of wider topics as well, like obviously we had a little bit there from Alice in terms of unemployment. How do we see the occupier markets? Let's take Spain at the moment. Do you see occupier markets growing, that they're becoming more employment and therefore potential for higher rents and higher take-up? What's the situation in the Spanish markets? Either Jorge or Alejandro, whichever.
Yes, well, and despite the fact that unemployment is getting better in Spain, it's still far from where it should be. I think, I mean, definitely if you compare it to other European countries. And we are seeing the occupier market start to push forward now. I think we had a couple of 2 or 3 years back, investment started to surge, and everybody was banking on rental growth and the occupier market. But we weren't seeing rents get to where they should be. So we had 2 different speeds, an investment and the occupier market. And now the occupier market has started to pick up some speed. A lot of it is also due to the fact that a lot of the office space in Madrid and Barcelona was very outdated, and that was difficult to justify rental increase with, you know, very outdated office space. A couple of big and very interesting new projects, refurbishment and repositioning of buildings in office buildings in Madrid coming around, and that's what I think that's what's pushing rents higher at the moment. The fact that you can finally find a decent quality updated space in Spain. So you have a couple of big movements, but all sort of around the same area. You have 3 out of the 4 big fours moving space in Madrid. So that's definitely got things rolling around. And the fact that they freed up this space that they were taking before has opened the possibility to renew the space. So we are seeing employment change towards the better, and it is increasing, but still a bit too slowly, I think, compared to the investment market. So it's going to be a matter of catching up to what's already been invested in, and then finally being able to see the returns that were initially expected.
Okay.
Yeah, and in my opinion, one of the reasons is the crisis was very good for efficiency. Yeah, because the activity is growing, the GDP is growing 3% per year, but the employment is not growing in the same way. The issue is that the companies are more efficient and they need less people to do the same or more. This is part of this. And the other hand, in terms of the occupancy, is the administration, because the public sector was one of the main occupiers in the office market. Around 20-30% of the total demand is coming from this in the past. After the crisis, there are obviously reorganization, and this type of demand disappear. And this is part of the explanation of why the occupational market is not growing like the investment side. Mm-hmm. But this is long-term reasons.
And Bill, what about the markets that you're working in? Italy and those kind of Southern European SEE markets, are you seeing chances for rental growth, occupier demand increasing, or are they fairly static?
I think they are increasing. As I said, you do have this bifurcation, and it is interesting. I think there's certainly a stronger dynamic in the institutional quality space for that growth. But I remember in a prior life working for a private equity fund and was managed out of the US and being asked at a certain point, where does the growth come from in the particular investment we were looking at, in the city we were looking at? What's the raison d'etre of, I can't remember what the city was, and it was like, well, what's the raison d'etre of Kansas City? I don't know why Kansas City exists. I don't know what Kansas City. There may be a good answer to that, by the way. But it was it's fundamentally an urban hub which has reached a certain level of critical mass, and therefore you end up in a dynamic. And I think this is the important point to bear in mind. You end up in a dynamic which is recovery fuels employment, fuels demand, fuels recovery, fuels employment, fuels demand, and that's about sentiment. That is driven by the turn in sentiment in the economy and some other factors, but it's largely about sentiment. And that, I think, is a critical factor, because if you ask me to give you the data to support a view that we're going to see recovery in Athens office rents, or in Athens retail rents, or in Nicosia, it's tough at the moment to find that data, because the data would show you we're bouncing along. But I think what is very different today from what we saw 6 months ago or 9 months ago is the sentiment's changed. And so we see in properties we're involved in those markets, people starting to look, not huge volumes, not mega demand, but interesting tenants coming looking for space. So I think there is reason to believe that the turn's happening. There are still macro and external risks to that. But if you ask me for the data to support it, I can't. It's still in the anecdotal level.
Okay, Tassos, and are you seeing that change in sentiment? Did it start when we announced that we were doing this event?
Yeah, got flowers and chocolate and everything. The sentiment is turning. If not anything else, just judging by the names of investors who are coming into the market, big names, big ticket investments. Now, I think that anticipates an upturn in demand. There's some strong headwinds. I think it will happen slowly but steadily. It will happen. And as I said before, there's a dearth of prime stock into the market. And that's going to drive values up, and that's going to generate opportunities, if not to buy existing stock, which is out of circulation, just build something new for the demand that's picking up.
I think on a sort of very basic level, what we see from some sort of clients, I think, is that if you look at sort of basic criteria, I mean, the yields are higher there. There's less perception now about currency risk. There is GDP growth. There is a view that there will be rental growth, partly because of shortage stock. So it does, and you potentially got, as more weight of money comes in, sort of further sort of yield shift. So there is, there's some basis for what's happening. I think equally, we find clients say, well, we've got to look at what the market's going to be like when we exit, as opposed to what is sentiment like now, and what will happen to all the external capital. Will it go? Is there a local market, etc.? But certainly is I agree, it's sort of from a sentiment perspective, a much more positive story than it was.
Okay, good. And Spain, I mean, the sentiment there, I had a discussion with Merlin, just speaking to David, saying, you know, what, are you going to look outside of your markets now? Because, you know, huge transaction volumes ahead of everybody pretty much in Spain. And his view was no, because there's still opportunity for us here in this market for us to go for before we even begin to look at Portugal or outside of that. And that picks up in a way where we are in the cycle. Do you see that there's still increased opportunities for institutional money to come in? Or do you think that you know, the Socimis are all going to take everything anyway, so there's no point in competing? But I mean, his view was very much that this was unfinished business. He'd got a lot of business still to do in Spain. What's your kind of thought on that?
Yeah, like you say, I think the Socimis take the big part of the market in terms of the commercial real estate, because they have a lot of equity to invest. I think there are different ways. The first one was NPLs and REOs. I think it's 2013-14 was the activity very, very focused on this. From 2015, I think starting the Socimis, the REITs, taking the control over the existing companies that disappear, and there are the new property companies that they are control the commercial real estate income producing assets. And now from 16, I think is the timing for development, because it's, there are an opportunity to create a new stock, mainly like Alejandro said before. This is very old-fashioned type of assets, mainly in offices, residential too. Our activity is more focused on student housing. That is a new market that attracts a lot of new institutional investors. Was closed a big transaction these days in student housing from AXA, that is an insurance company. Well, it's an investment manager mainly. And I think the activity will be concentrated in the niche or alternative investment, that there are a lot of opportunities there where the traditional investors are not looking for. And the other is development, because there are IPOs coming. This is a joint ventures between local developers and international capital coming to create a platform for residential to sell and to let, because it's the opportunity to create a new stock. The new generation is the young people don't have a stable job, and they are looking for let in place to buy. And there are a lot of movement between cities and countries, and I think this is a new trend in the social life, and I think it's the way to create a platform for this. This is my perception.
I think clients of ours find it very hard if they're trying to secure an asset to compete with the Socimis, because they've got such a lower cost of capital. They've got sort of target distribution yields of, say, 5 or 6%. So it is a very competitive situation when you're trying to secure asset against them. And we've seen examples where, however, because they can't acquire a business interest because of the local REIT legislation, if for example, in hospitality, they're at a disadvantage, because then they have to JV with another entity that will acquire the business and take a lease from them. And generally, so certain cases they're less competitive. But it is a very big market, and apart from the 4 main Socimis, I think there's another 17 economies which are on the alternative investment market there. And we've had clients buy, for example, a client bought a Spanish shopping centre last year, and it was put into a bespoke Socimi, which is listed on the alternative exchange, and that's purely really to get the tax benefits of being a Socimi as opposed to an underlying listed entity.
Okay, and is there any action in terms of the listed sector in Greece at all? Tassos, is there any activity there?
Well, yes. the market's dominated by two large REITs. Their portfolios are of the tune of 1 billion each. They were initially set up by systemic banks. Now they're owned by foreign investors. So one has been owned by an Israeli family and now on the market for a new principal investor. And the word has it that PIMCO is actually very interested, which is a good sign. The other one is controlled by Fairfax Financial from Canada, huge investor. But there has been a pipeline of REITs coming to the market, but I suspect many of those were just tax shielding vehicles. They were not trying to capitalize on the demand of the upturn. They were just trying to minimize their tax liabilities. I think the truth is somewhere in between. There is demand. People, for example, the shopping center transaction with Barde, that's a brand new REIT. It's partly even driven by tax efficiency, but also through an upturn in demand. In terms of new activity, is more slanted towards tax efficiency as opposed to demand, like Spain. But there are things happening, yes.
Okay, good. And I wanted to just pick up with you, Bill, the NPL side of it. Obviously, we've heard Tassos' view in the presentation. Do you broadly agree with that in terms of Greece, Cyprus, and what's your view on the Italian market? How quickly that will continue to happen? What's your sense of that? And is there still opportunity in Spain for non-performing loans?
I think, yes, broadly I agree with Tassos' observations. I think it's critical to remember that, sorry, I keep coming back to this point, but again, this point about bifurcation. If you look in Cyprus and Greece, you've got 125 billion euros of NPLs sitting on the balance sheets of the banks. A large chunk of that is mortgage secured. These are markets where typically, however, that mortgage security wasn't, I'm lending you the money to build a shopping centre, therefore I get a mortgage on the shopping centre. It was, I'm lending you the money to finance your shoe business, and therefore I get a mortgage on your shoe factory. So the quality of the collateral is, as I say, not institutionally investable real estate. It is granular, low value, difficult real estate. And the vast majority of that secured, or of those loans which are secured on real estate, don't fall into the category that institutional investors would want the real estate that's underlying that. Which doesn't mean that there's not anything going to happen on that. The big investors who are shopping NPLs in Greece right now are looking also at granular portfolios, lower quality portfolios, but they're looking at them as portfolios to buy and trade out of the granular assets rather than portfolios to buy and get some institutional quality assets they want to own and keep. There are exceptions to that. I think to the couple of transactions Tassos mentioned that are in the market right now, actually they're at the better quality end of the spectrum, but the reality is that most of it's going to come out in those granular forms. So I think there are opportunities in Greece and Cyprus, but you need to know what those opportunities are and have the appetite to be interested in owning a disused shoe factory. That's probably a bad example. They shouldn't have much appetite for that, or a bunch of apartments or a bunch of shop units, or those lower value granular assets that need to be then traded out of. I think if you come to Italy, what is interesting to me is that's a huge market, 300 billion of declared NPLs, probably closer to 500 billion once you add in the impaired. The volume of activity there relative to that stock remains relatively slow. If you take out the big transactions in which KKR and PIMCO are involved, the Project Fino transaction with UniCredit, 20 billion, once you take that out, actually there's really, in percentage terms, not much happened. I think I spent part of my life being an Italian investment banker, and I would say from that experience, and I used to be part of it, that the Italians always believe there's a structure. Everything can be solved with a structure, and of course at some point there's not enough underlying demand. Sorry if I'm offending any Italians in the audience, but as I say, I used to sell part of this idea. As there's still an underlying hope and belief in Italy that they can solve it with a structure. And of course, that's never going to happen. Now, what is interesting in Italy is the GACS scheme that the government has implemented has been actually relatively positive for the banking system, I think. And I think it looks long-term positive for the banking system. I don't know, and I think because of that, it's relatively long-term positive for the Italian economy. Having said which, I think it actually produces a tremendously inefficient resolution of the underlying NPLs and recovery against the real estate. So it's, but it's at least starting to unclog a bit of the banking system, and so it will achieve some desirable goals there. I do think that will continue to produce opportunity. If you look at it, the government guarantee on the GACS securities is we will guarantee anything which is investment grade fundamentally, which is interesting because you pay a premium to get the guarantee of someone who's low investment grade. It actually has no real theoretical credit enhancement to the Italian government involvement. But what's really going on, don't quote me on this, is that the ratings are being pushed. The low investment grade securities, I wouldn't buy them at low investment grade yields. I think they're far more risky than is apparent, but it's okay because now the government's guaranteeing them. So what does that mean? Sorry for this long-winded explanation, but what that means is just you're transferring the problem away from the bank and longer term to the government. So you've actually got this process which is implicitly the transfer of NPLs to the government and will have to be managed out in some fashion by the government from the GACS scheme. And that is an opportunity. There will be the opportunity to buy out of the GACS scheme. There are lots of assets that are not GACS eligible. We're seeing the Italian banks right now with their huge leasing portfolios, and I'm talking very, very large leasing portfolios, and they're not GACS eligible. So there are opportunities in these less institutional quality portfolios. I think once you get to the really high quality assets in Italy, that's a tough market because everyone's already gone fishing there. Spain, honestly, I don't know. We have stayed away from Spain, not that we don't like it, but actually because of the way the Spanish government intervened with Sareb, which in terms of our business really limited the opportunities that we could see there for that. I think there are opportunities still in Spain, but it's clearly at a much more mature state of the market. I think they're much less getting large aggregate discounts on portfolios and making your money that way. I think, actually, to Tassos' example, the recapitalization business in Spain is a far bigger opportunity than the portfolio acquisition in Spain. We would certainly, as a general view, take the view that Spanish NPL portfolios are expensive today.
I agree.
One thing we've seen on the GACS scheme is because in order to provide the guarantee under EU state aid provisions, they have to charge a market rate for that guarantee. And that does affect the sort of application of the guarantee and its sort of viability for quite a lot of transactions. So I think it'd be interesting to see how it develops in that context. But just looking at the sort of NPLs across southern Eastern Europe more widely, I think one further complication we've seen is that a big part of the market in places like Spain and other places is loan-on-loan financing by certain banks. JP Morgan, Morgan Stanley, Deutsche will provide that loan-on-loan financing. And normally they expect to be taken out within about 18 months, 2 years maximum. Whereas there's a view with some of these other jurisdictions where the enforcement process is more complicated, that won't be deliverable. And that therefore that loan-on-loan financing won't be there in the same volume or depth, and that will affect the sort of equity returns that people will be seeking. I mean, the other thing is that there's so much sensitivity about the banks writing down losses that there's still not demonstrably clear there's a lot of local business that these banks can demonstrate to create profits to mitigate the write-down of losses. So we've seen transactions where the methodology adopted to stagger that write-down is an important part of the underlying transaction.
Okay, good. I wanted to dive down a little bit into some of the sectors. Jorge, you mentioned student housing, particularly in Spain. What's the position there? do you see the growth of that coming from domestic students or from students from abroad? What's driving that? Is it going to get close to the kind of UK model in a way where you've now got a huge amount of student housing? What's the sense of where the market's going?
Well, the fundamentals are very good because Spanish universities are in the top 10 in Europe, and there are 3 of them in terms of the business school mainly. I think it's very attractive on this. On the other side, the lifestyle in Spain, Madrid, Barcelona is very attractive for European students. But this is not more than 20% of the total. I think mainly is the local students moving from different countries, from different cities into the country. Employment is very difficult at the moment. Find a job is good fighting between students. And I think everybody is looking for the best universities to be well positioned. This is something that creates movement between different cities. And on the other hand, it's very attractive for Latin American students. A lot of people coming from Mexico, Colombia, and this type of countries create a good activity in this way. The fundamentals are very good, but on the other hand, in terms of the real estate, the stock is obsolete. It's more than 80% of the total stock, that is around 90,000 beds available, are absolutely obsolete. This is coming from the institutional, religious institutions, and coming from the public universities, and the accommodation is not real in line with the international standards. International developers come in and investors trying to renew the stock and create a new market. And this is the way that we are looking at good opportunities. And obviously the market that we have here in UK is absolutely the model to follow. And this is the point.
And Alejandro, is there movement also in the other alternative sectors like, so for example, parking has become much more of an investable sector, senior living, those kinds of things. What's happening in Spain?
Yes, you do find investors turning to more alternative investments just because they don't seem to find the returns in the more core markets. But to be honest, we aren't seeing massive interest in things like parking. Senior living, yes, a little more, but I think out of the considered alternative markets, I think student housing is definitely the protagonist for the time being. I think there's a sense of not knowing where parkings are going to go from here onwards, with the cities regenerating, and at least in Spain, the bigger cities are more and more trying to push cars out of the city centers. So I think if investing in parkings in city centers is, some people love it, some people hate it. If you love it, it's because you think you're going to be able to park your car when nobody can drive into the cities, but you can still park it if you have space. Another say if you can't drive your car into the city, the parkings are going to be obsolete. So it's a bit of a love-hate market. Same with petrol stations, which have been, there's been recent portfolios in the market with petrol stations. Again, some people bet wildly against it, and others are extremely bullish about petrol stations. I think all in all, the more popular alternative investment markets are student housing and senior living.
And how do you see those in comparison? I mean, it was interesting when Alice pointed out that industrial and logistics was relatively low, whereas I would have thought actually that would be an increasing market for Spain. What's the position there? Do you see that growing with e-commerce, or how's the market at the moment?
Yes, I think the only reason why it's relatively low is lack of quality product, and there is a considerable development going on, and it's definitely something that's on the radar of most core investors. And again, Spain is lagging a little bit behind the Anglo-Saxon world in terms of e-commerce and the necessary logistics to accommodate it. But it is catching on, and it is growing. And I think that we do need to update and especially increase our logistics capacity to be able to provide e-commerce a fighting chance of taking over a bigger chunk of traditional retailing. And I think it's going to happen. It's just a matter of time.
Okay, good. And David, in terms of the appetite of international investors looking at SEE, Greece, is that really, from your experience, focused mainly on hotels and the leisure sector?
I think the one, certainly insofar as we've had involvement in Greece and Croatia and those sorts of jurisdictions, it's almost been exclusively hospitality related. And that's based on obviously they're de-linked from the local economy. And they can bring the same asset management skills that they have wherever the hotels are. And they're buying them at a significant discount to replacement cost. So, and sometimes these are special situations where hotels are going into a JV with a strategic partner who will then take those hotels as part of a wider portfolio and then put further money in. In other cases, we've seen situations where there's like a local listed company, for example, in Croatia, which does a lot of hospitality. So I think a lot of the hospitality investors who found it hard to find stock in Greece and in Spain, places like that, have looked at those jurisdictions. And it partly goes back to, I suppose, the political risk issue that's now seen as potentially less of an issue.
If I can, just on that point, I mean, and certainly, there's, as Tassos said and David said, there's a queue of people saying, can you find me hospitality assets in Greece? But what is interesting to me is, if I went back a few years, I was trying to work it out before talking to David and Tassos Kotzanastassis here, but I think it's probably actually 3 years ago. We used to go and see investors, and we'd be chatting with them, and we'd mention Greece, and they'd say, don't talk to me about Greece. And 2 years ago, you went to see them, and you'd mention Greece, and they'd say, oh, what's going on in Greece? That's interesting. And then, my date's going to be wrong here. Then a year ago, you'd go and see them, and they'd be saying, they'd be ringing up saying, can you come and see me and talk to me about Greece? And in the last 12 months, they're all in Greece, and they're looking right across the board at where is the opportunity. So I think the appetite to be out, whilst the hospitality sector, people get it, it's actually getting more fully priced. I'm not saying it is fully priced, but it's getting more fully priced. But people are definitely willing to look at a whole range of other segments of the market.
Okay, Tassos, is that what you're seeing as well, that the appetite is maybe hotels and leisure are the most obvious one, but that actually investors are now beginning to look at the other sectors as well?
Well, by necessity, yes. I mean, we had a ULI event a few months ago, and I was asked this question about alternatives, student housing and so on. And my answer was, you go to a man who is dying of thirst and you start talking about wines and grape varieties. That's not what they want to hear. The core sectors in Greece are undersupplied, office, industrial, retail to some extent. So yes, people started looking at hospitality with great vigor a few years ago, and now they realize that maybe there's more interest, more place in the core sector, and they are looking at that as well. But they wouldn't go to adventurous sectors like student housing. I mean, after all, Greece is an alternative market to start with.
Yes, sure. And in terms of, so too early really for redevelopment at the moment, because there's no requirement for that. There's a requirement for it, but no appetite for it.
The numbers don't stack up yet.
And just picking that up on Spain, obviously the numbers probably are beginning to stack up a lot more in Spain. There's been a big change in the residential market for sure, which had huge amounts of dead stock, half-built stock. Is now the main opportunity redevelopment? What's your sense of that?
It's definitely picked up. There are different types of residential, and the worst residential developments are half-built developments that sort of got abandoned in the past. Those are going to be harder to absorb yet, but there is a lot of development or redevelopment or continuing development outside the bigger cities, and that's where most of the local capital is focusing on, and some of the foreign capital as well, although foreign likes to stick more to the city centers where there is a substantial amount of demand for repositioning, redevelopment of buildings in Madrid and Barcelona city centers.
And
So it's doing quite a lot of private equity, like Lone Star, Varde, Activum, as I understand it, are all buying up building land for residential development in Spain at the moment.
is that coastal Spain or cities or?
I'm assuming it's near the coastal, but I'm not sure. But
If it has a vacational purpose, it will make sense.
Yeah.
But then you see some developments which at the time didn't even make any sense at all. And I'm talking in the middle of nowhere. doubling the size of a small town.
Yeah.
I mean, that
It's quite a wide actor. I mean, because I think it's not just English who go there. I mean, the Belgians, Dutch, Danish, Swedish. There's quite a lot of European investors who are buying in Spain at the moment.
The good issue is that I think the joint ventures between the local developers and international capital creates an underwriting more, accurate. And where is the demand? What is the prices growing? And this is something that changed in this way. Because obviously the local developers knows about bricks, but not about Excels or IRRs. Yeah? And this is the good combination that we create a more safety and healthy market that I think is very good. On the other hand, the financing is more caution and more conservative. Banks are trying to look pre-sales or something that shows that the project is good. And I think this is the main difference between the past. Before the crisis and now, I think the financing is very, very well controlled. Yeah.
Okay, good. I wanted to just leave some space for questions before we have coffee and things. So has anybody got any questions? You can think about them, put your hands up and let me know. Tassos, have you got a question?
Not necessarily a question. I just want
to make
some observations.
Yeah.
I just started recently with Piraeus Bank. Piraeus is one of the four systemic banks in Greece and one of the largest by assets. And just to echo the observations by the panelists, I think the most important thing is the sentiment, the change in sentiment, that has brought a different air into the market. It's a small market with its own constraints, but nevertheless we see now a flurry of activity in relation, of course, to earlier years. And to the best of my knowledge, all the Greek banks are there to support the right investment plans, including our bank. And one of the points I want to elaborate a bit more is the possibility to upgrade the existing building stock. Because the observation that was made already by Bill and Tassos is that we have a building stock that is in need of modest to heavy capex. In either process, the product can turn into investment-like quality, not reach the quality standards that expect, but nevertheless, this would enable some more activity in the market. So, by all means, the market is there, it's up for grabs, and definitely I expect this autumn and early next year, we'll see more activity, more things coming, primarily in the hotel sector, but also in the rest of the sectors too.
And so, is this a change? I mean, I know it's a change for you to be at Piraeus Bank, but is it a change in terms of the lending that they're prepared to do? Is that an indication that they're now freeing up more, they have more funds to be able to lend, or?
The Greek banks have not stopped lending, to the best of my knowledge, as far as I have been following them over the years. The difference now is that all of the banks have taken action towards the NPLs and NPEs. So they're tackling that side of the equation, and therefore they're keener and able to look at the new lending possibilities, supports new investment activity and so on. So I would say things are moving in the right direction. The banks are there, they're happy to talk, and we see what comes along.
I think someone much cleverer than I am once said that you only get through an NPL crisis through the denominator effect, i.e. it's increasing the aggregate balance of loans that ultimately gets you through an NPL crisis, either as a bank or as a country. And I think what has changed, very much to Tassos' point, is that the Greek banks still have huge problems to sort out, but they've sorted out enough problems that they're now very focused on the new business production and I think on the denominator effect. And it's very interesting to me because I agree with Tassos. They've always been there to lend, but there were periods when the products they advertised, as I'm thinking here particularly in the residential sector, nobody could quite satisfy their credit criteria. So actually they were still in the market, but they weren't really doing very much. It's very modest volumes. And there's a sizable pickup in the new loan granting by the Greek banks. I think it's still slightly credit contractionary net, but it's improving, and I think we're very close to a situation where we'll be, where there will be credit creation in the market.
Okay, good. Yes, Jane, go ahead.
So still on Greece, a question for Tassos. I think you said that you had an office in Asia or links to Asian capital. I was just wondering whether there's much Asian interest investing in Greece now. I understand one or two, like Costco, one or two Chinese companies have invested in infrastructure projects or interested in infrastructure projects in the country. Is that a trend you see kind of increasing over the next sort of 12 to 24 months?
That's right, yes. First of all, get things straight. Our office in Asia is predominantly for our principal activities in the region, so we're not doing it for cross-border capital. Having said that, this is going to change because some of the investments that we have done in Asia have now reached the end of their lives, and the Chinese families behind it are looking into Greece. And this forms part of a pattern. You're correct in saying that there has been lots of Chinese capital coming to Greece, and it's part of the so-called One Belt, One Road. They started targeting infrastructure like the Piraeus port. They're looking at the Thessaloniki port as well. They recently got into energy, liquefied gas. They are also partnering up, they have partnered up with the largest developer, Land Development, for the regeneration of the old Athens airport, which is a massive 8 billion development scheme. Some other non-real estate businesses as well, but we do see a substantial influx in the areas of tourism, infrastructure, and real estate. And as far as I understand, the Chinese government has by and large lifted the restriction on the export of capital for Greece. It's one of the strategic countries that they are allowing outbound investment.
If I may, sorry, I'll stop jumping in every question, but just
It's allowed, but it's fine.
the other thing, and it's been in the papers here a little bit in the past few days, is the Chinese investment in passport schemes. And I mentioned that actually because my colleague Pavlos Luizou, who's badly dressed over there, who works with Bank of Cyprus on the management of their NPL portfolio, and in particular on the management of the real estate elements of that, has been involved in quite a lot of transactions where the real estate's been sold to Chinese passport buyers. I mean, what's the volume of passport buyers in Cyprus at the moment, Pavlos?
We do about 300 to 400 passports per year, roughly.
And that's 5 million a pop.
2.5.
Sorry, 2.5 million a pop. Yeah. So it's €1 billion going into Cyprus from passport buyers into Cyprus real estate. And how much of that is Chinese money? Do you know?
We don't know exactly, but safe bet would be around 50%.
As a matter of fact, Chinese are not allowed to have dual citizenship, so that what they buy is the green card, so it's the residence permit. But yes, there's a substantial influx of seekers of green cards, both in Greece, mostly in Cyprus, and to a lesser extent in Greece, and I think it's going to continue.
I think in Greece, Tassos, the investment requirement is much lower, isn't it, than Cyprus, about 250k or something?
I think they're about to pull a coup into the market and bring it down.
But I think the current thing in Greece is you're buying a visa, not a passport. Whereas in Cyprus, you're buying directly a passport.
They have both visa, 300,000 passport too.
So last question, which is to try and get some concrete kind of views on where we should invest. Let's start with you, Jorge. Where do you think people should invest their money? You've got all of the money from everybody here in the room. Where would you invest it on their behalf?
Well, when we are talking about residential, I think it's a good opportunity there. Mainly development, obviously, because the returns are higher. You are taking some risk, but I think it's a more healthy market now and could be possible to think in a good way. It's very important local partner because locations and planning and everything related with the local administration is absolutely need to have a local partner. And looking after the sectors, I think Resi with student housing will be a good combination. And don't forget Lisbon and Portugal, because we are thinking mainly in Iberia market that I think is Spain and Portugal jointly, because Portugal is a very, very good opportunity to think about.
Okay, good. Alejandro.
I agree with Jorge on the Portugal side because it's actually a very good opportunity to buy at a very good price, quality assets as well. And in Spain, I would recommend buying outside of Madrid and Barcelona. There's so much more country than just those two cities where everybody seems to be focusing their attention on, and that's what's driven yields for the good stuff beyond where they used to be even. So with a little bit of imagination and patience to reposition, redevelop, you can also find very good opportunities in Spain still. But definitely explore the other main province capitals because there is a lot of good stuff, and I think it's definitely worth broadening your view, no? Because obviously the core funds are strictly Madrid and Barcelona, and that's just close to impossible to find decent returns at the moment. So, big country.
Good. Bill.
Look, I think there is a good macro right across the region at the moment. And, sort of macro level, I think all of the markets we've been discussing today probably make sense. I'm a little more cautious on Spain, but just because it's later in the cycle. I think the thing that I would really look at is how do you access the value in the market? If you go in and you try and buy institutional assets or you try and buy an NPL portfolio that's being marketed, you're going to end up paying up. And I think my comment would be perhaps rather than having a view on a segment or a geography would be the distressed, incomplete developments which are either owned by banks or which underpin their NPLs are now at a stage where the recapitalization opportunities to get those developments going again, I think, are starting to present some really interesting opportunities right through the region.
Okay, good. David.
I suppose it probably depends on the sort of return that you're looking for, but I think I'd probably be trying to target things below the radar of the larger investors. I still think there's a number of opportunities in the hospitality sector. The alternative asset classes, to the extent to which they're driven by demographics. I mean, those demographics will apply in the sort of Southern Europe as much as anywhere else. So I think that will be a grey market. And as the NPL market comes in, I mean, we've seen in Western Europe that's triggered opportunities in terms of doing discounted purchase option deals with borrowers, or then once the purchasers have acquired the loans, buying individual assets off them when they get to their sort of loan repayment amortization type dates. So perhaps look for those sort of opportunities as well.
Okay, good. And last but not least, Tassos.
Thank you. I don't have the pan-European view that I used to have in my previous life, so we tend to focus on the exotics. In terms of Greece, what I see is opportunities in joint ventures, recapitalizations. If you're going to do NPLs, be prepared for granularity. You won't have the large portfolios, large assets you have in other markets. In Greece, I would keep an open eye, an open mind, and be fairly sector agnostic. I wouldn't push myself down hospitality just because it's getting crowded. And just a tip for things that are coming up, Turkey is building up a very, very substantial NPL problem. And please don't laugh, so is Russia and Ukraine. But for the purpose of this discussion, SEE, what I said about Russia and Greece, and keep an eye on Turkey over the next few years.
Okay, great. Thank you.